What if I told you there's a company that made more money in the first 3 months of this year than it did in the entire 12 months before that? Not double, not triple. We are talking about a 7.5 times explosion in revenue, hiding in a stock that most of Wall Street still hasn't woken up to. Today, we are breaking down Rezolve AI, ticker RZLV, and asking the question everyone in the trading community is whispering about right now. Is this the AI stock that's about to trigger a massive short squeeze? Because when you combine deep value fundamentals with a short interest, this high and a buyback engine this large, you get a setup that only comes around once in a very long while. And by the end of this video, you'll understand exactly why the shorts might be completely trapped. Now, before we dive into the numbers, if you find this breakdown valuable, do me one quick favor and hit that like button and subscribe if you want more deep dive stock analysis like this one. It genuinely helps the channel more than you know. All right, let's get into it. Imagine finding a company that generated more revenue in the first 3 months of this year than it did in the entire previous 12 months combined. Today is July 5th, and we are looking at a fundamental disruption in the AI sector that most of the market simply hasn't priced in yet. We're talking about Rezolve AI, a company that is currently transitioning from a speculative tech play into a high-margin, hyper-growth machine. This isn't another vaporware AI story riding a wave of hype. This is a company putting up real, hard, high-margin software revenue. But to understand why this matters right now, in this exact moment, we have to look at the structural gap between what this company is actually worth and how it's actually performing. In the world of finance, the holy grail is what we call an asymmetrical opportunity. That's a situation where the potential for upside vastly, and I mean vastly, outweighs the downside risk. And Rezolve is currently sitting at a rare intersection of three powerful forces all at once: explosive fundamental growth, a massive valuation disconnect, and a technical setup that is primed for a mechanical squeeze. Think about that for a second. While countless AI stocks are trading purely on dreams and press releases, Rezolve is trading on cold, hard, high-margin software revenue. So how do you get a company with real revenue trading like it's an afterthought? Well, if we dig deeper into the actual numbers, the trajectory becomes almost unbelievable. Look at this. Rezolve just reported preliminary first quarter 2026 revenue of approximately $60 million. Now let that sink in for a moment. For context, their total revenue for all of 2025 was just $46,800,000. So they made more in a single quarter than they did in an entire year. And management isn't stopping there. They've reaffirmed their guidance for $360 million by the end of the year, representing a staggering 7.5 times growth surge. On top of that, they are targeting an annual recurring revenue exit rate of $500 million by December. Have you ever seen a company scale this fast and stay this quiet? Now, explosive growth is fantastic, but here's the thing that separates the winners from the flash-in-the-pan stocks. It's the moat around that growth that ensures long-term survival. So what exactly is Rezolve's moat? Well, Rezolve is now the engine behind everyday cashback for Mashrek, a $91 billion regional banking giant. And this isn't just some small pilot program destined to be forgotten. It's a deep integration with Visa that puts Rezolve's AI directly into high-frequency transactions for millions of cardholders. Think about the sheer scale of that. Simultaneously, their SQD data layer is seeing data volumes increase fivefold in just 4 months, now processing 1.4 petabytes every single day to support over $20 billion in assets. This is the kind of infrastructure that competitors simply cannot replicate overnight. But while these growth numbers already look incredible, there is one hidden metric that management just authorized that completely changes the entire supply and demand dynamic of this stock. And most retail investors have absolutely no idea it's coming. In a massive show of confidence, shareholders just approved a mandate to repurchase up to $300 million in shares. Now, why does that matter so much? Because at current prices, that buyback could effectively retire over 25% of the total shares outstanding. Just imagine 1/4 of all available shares being pulled off the market. This is management essentially standing up and shouting, "The market is wrong about our value, and we're going to use our own balance sheet to prove it." When a company is willing to bet $300 million on itself, that tells you something. And here's the kicker. It's not just the company buying. The so-called smart money is following right along with them. CEO Daniel Wagner has personally accumulated roughly 9 million shares since the start of the year through private deals and equity. Think about that. This is the person who knows the company better than anyone on the planet, and he is buying with both hands. At the same time, Institutional ownership has climbed to 28%, with a trailing 12-month buy-to-sell ratio of 6-to-1. 6 shares bought for every 1 share sold. When insiders and institutions are accumulating at this kind of pace, it usually signals one thing, that a floor has been firmly established under the stock. So if the insiders are this confident and the institutions are piling in, where do the professional analysts actually think this stock is headed? Wall Street analysts currently maintain a moderate buy consensus, but honestly, their price targets tell a far more aggressive story than that rating suggests. The average target sits somewhere between $11 and $12, while the high forecast reaches all the way up to $15. Now compare that to where the stock is trading today, and you're looking at a potential upside of over 400% from recent trading levels. And these aren't fringe analysts either. Cantor Fitzgerald and H.C. Wainwright are leading the charge here, both citing the company's high-margin software model as the core of their bullish thesis. But wait, if the upside is genuinely 400%, then why on earth is this stock still trading under $3? How is that even possible? This, right here, is what I call the fundamental disconnect. You have a company guiding for $360 million in revenue, with 90% software margins and a massive buyback engine loaded and ready to fire. And yet, the market cap is only sitting at around $1.1 billion. Does that make any sense to you? In any normalized market, a high-growth AI software company with these kinds of margins and this kind of trajectory should be valued significantly higher than it is right now. The gap between the story the fundamentals are telling and the price the market is offering is enormous. But here's the reality. None of this fundamental strength matters for a near-term move if the technicals don't support it. So let's shift gears and look at the launch pad that's quietly forming on the chart. Since early June, RZLV has been building what traders love to call a clean stair-step advance. What does that mean? We saw a sharp spike above $3.30, and then, instead of collapsing, the stock went through a very controlled, very healthy pullback to digest those gains. That's exactly what you want to see. We are now basing in the $2.80 to $2.85 range, which is acting as a critical support zone for the next leg higher. This isn't a chart that's breaking down. This is a chart that's coiling up. But here's where it gets truly interesting, because the shorts are officially trapped. And I mean trapped. Short interest currently sits at 22.54% of the float. That alone is a massive number. But now look at the borrow fees, because this is where the real story hides. The borrow fees recently spiked to an absolutely insane 194.3%, and they are currently holding around 80%. Do you understand what that means? Short sellers are paying a massive, punishing premium just to stay in their positions, while the stock stubbornly refuses to break down. Every single day they wait, it's costing them a fortune. That's a pressure cooker with the lid screwed on tight. And if we peek into the options market, the pressure is about to hit an absolute boiling point. For the July 10th expiration, we have significant call, open interest at the $3 strike. So what happens if the price breaks above $3? Market makers will be forced to buy shares to hedge their positions, and that creates what's known as a gamma squeeze. It's a self-reinforcing buying loop that can send a stock vertical in a matter of hours. Meanwhile, heavy put interest down at $2.50 provides a solid safety floor for the bulls. So you have limited downside protection and explosive upside potential built right into the options chain. When you combine every single one of these factors together, you don't just get a bullish setup. You get what I call a mechanical powder keg. Think about everything we've stacked up here. You have high short interest. You have a looming gamma squeeze. And you have a $300 million buyback mandate, all converging at the exact same time. This creates the potential for genuinely explosive price action, because the exit door for the shorts is extremely narrow, while the buying engine for the company and the institutions is wide open. It's a fundamental imbalance between panicked sellers who want out and confident buyers who want in. So the natural question becomes, how do we actually trade this for the week ahead? For the short-term swing trader, our entry zone is between $2.80 and $2.90. What we need to see is $2.80 holding firm as immediate support. Our primary resistance is that psychological $3 to $3.10 line in the sand. If we break above that level with real volume behind it, our target for next week is a retest of the highs, somewhere between $3.35 and $3.50. That's a clean, defined plan for the active trader. But for those of you looking at the bigger picture, the strategy is even simpler and, honestly, even more compelling. If you're an investor rather than a trader, you ignore the weekly noise entirely and you focus on that $10 to $15 fair value target. The plan here is straightforward. Accumulate heavily at these sub $3 levels and then allow the $360 million revenue guidance and that powerful buyback engine to play out over the rest of 2026. You're not trying to time the perfect entry. You're positioning yourself early in front of a story that hasn't fully unfolded yet. So after breaking all of this down, what is the final verdict on Rezolve AI? Before I give you that verdict, I need to be completely clear with you. Everything I've shared in this video is for educational and informational purposes only. I am not a financial advisor, and this is not financial advice. Stock investing carries real risk, and small cap stocks like this one can be especially volatile, meaning you could lose money. Please do your own research and consult with a licensed financial professional before making any investment decisions. Never invest more than you can afford to lose. With all of that said, here's my honest take. Rezolve AI represents a rare, asymmetrical intersection of deep value fundamentals and explosive technical momentum. With a 7.5 times revenue surge, a $300 million buyback, and a short squeeze setup that is primed and ready to pop, RZLV is genuinely one of the most compelling setups on the board right now. Whether this powder keg actually ignites, only time will tell, but the ingredients are absolutely there. Now I want to hear from you. If this short squeeze plays out and RZLV hits that $15 analyst target, where do you think it goes from there? And would you have the conviction to hold? Drop your answer in the comments below. I read every single one. And if this breakdown helped, you see this stock in a new light, smash that like button, subscribe, and turn on notifications so you never miss the next opportunity before the crowd catches on. Thanks for watching, and I'll see you in the next one.